Accounting equation and Excel. Make a loan payable amortization table. Get ready and some coffee because we're learning the accounting foundation, the accounting equation, using Excel. We are first a word from our sponsor. Yeah, actually we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our crunching numbers is my cardio product line. Now, I'm not saying that subscribing to this channel, crunching numbers with us, will make you thin, fit, and healthy or anything. However, it does seem like it worked for her. Just saying. So, subscribe, hit the bell thing, and buy some merchandise so you can make the world a better place by sharing your accounting instruction exercise routine. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. In Excel, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 4 tabs down below: example, month 1, practice, month 2, example, in essence, the answer key. Month 1 being the prior month that we can use as a reference tool, the practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. The month 2 tab is basically the old blank tab where we started out with a blank worksheet but are basically continuing on within a template at this point. However, we will be adding to the template as needed as we go, practicing our Excel tools as we do so. Let's go to the example tab to get an idea of what we will be doing. We now have a new month of operations that we are working in, the prior month numbers being the start of our accounting equation. For month number 2, we're going to do a few more accrual type of transactions, meaning we'll have some more accounts payable transactions and some more accounts receivable transactions, which we looked at last time. And we'll also be dealing with the loan payments a little bit more. That's the first thing that we want to put into play here. So whenever we deal with a loan, we're going to have a loan payable on the books. Just a couple things to point out with regards to the loan payable. One is that when we put it on the books, we might have a short-term and a long-term portion of the loan if it's a similar loan to what we are most familiar with, like a home loan, in which case we have installment payments made on a monthly basis, the loan quite possibly extending longer than a year. Therefore, to properly record it in the categories of liabilities, we should have a current and a long-term portion. Now, that becomes problematic to do as we go with every payment, because every payment would change the short-term and long-term portion of the loan. Therefore, I would recommend from the bookkeeping side of things, we combine the loan together, having one loan, either grouped as a current liability or a long-term liability. I tend to use current liability because all loans will typically have a current portion if they are installment loans, while only some loans will be extending beyond a year and therefore have a long-term portion. But you could have some loans that don't have current payments because the business structure might not be an installment loan. You might just owe all the loan back at the end of the loan. It could have a different structure than an installment payment. But that's typically what I would do, group them together into one account. The other problem that we have is that you might have multiple loans. So if you have multiple loans, your option is, do I want to group all the loans together in one account, loans payable, using the subledgers of, in essence, the amortization tables coming from the loans as support of that one account? Or what I would recommend is having multiple accounts for each loan, which as we make payments, we can tie out to the amortization table as we go. So that's what I would recommend. And then at the time of financial statement creation, we can combine those loans together into simply one account with the use of possibly sub-accounts if you're using software like a QuickBooks or a Xero, or we can just group them together when we make our financial statements. Noting, some businesses are not going to need multiple loans because they probably are just going to take one big loan to buy what they need and whatnot. But other businesses are likely to have multiple loans, especially if they have a lot of equipment that they're purchasing, like construction companies, because you might have particular loans that have the collateral of the equipment that you took the loan out for. And that means you could have a whole bunch of loans that you're going to have to track, make separate amortization schedules for, break out short-term and long-term portion, possibly periodically, possibly for income tax needs or external reporting needs. So the next problem we have with a loan is that I would like to, when I make the loan payments, if they happen periodically similar to a mortgage payment, make them with the bank feeds, meaning I'd like to, if using QuickBooks or Xero, automate the loan payments. But most payments that we make, it's easier to do that for like paying the utility bill or the telephone bill or something like that, because there's only two accounts that are impacted, and so one is cash, so you could see the transaction going through the bank, and the other side you just post to the proper account, which would be driven by the vendor. So you can automate those. But the loan is going to have an interest component to it. So although the loan payment will always be the same, the breakout between interest and principal will differ, meaning it's going to cause us problems for bank fee transactions in two ways. One is there's more than one account affected. There's two accounts. So we have to put that into play. You might be able to still do that with bank feeds, but the other problem is that there's a difference between the breakout between the two accounts of interest and loan payable with each payment. So that's really going to mess up the automation of the bank feeds if we want to tie out to the amortization table, which each payment that we make having our loan balance and interest accurately recorded with each payment. How do we deal with that? Couple ways. You could say that I'm going to not break out interest and principal, but just record the loan payments against the loan balance, not dealing with interest, which is incorrect. However, it's easy to do on the bookkeeping side because I could just do it with the bank feeds, and then periodically at the end of the year, either myself or the CPA firm creates or gets the amortization tables and then adjusts periodically the interest and principal. That could work quite well in practice, achieving the goal of automating to the best extent you can on a cashed basis for the bookkeeping side of things, using the tool of the bank feeds, while recognizing the imperfection of that process during the data input, but adjusting for it with, in essence, an adjusting entry done by either ourselves again or the CPA firm, telling them, hey, look, you got to fix this according to the amortization schedule to tie into the amortization schedule. Okay, so to do that, first we need to basically create an amortization schedule. So we've got this loan on the books of $72,000. Now you might get an amortization schedule like from the bank that gave you the loan, but they don't always, I'm scrolling all the way to the right where we're going to create this thing. But they're not always required to give you an amortization table, because you have enough information to make your own table. And so you might have to just build your own table with the information they give you, which I like to do in Excel. You could also do it on online services. You can just do a browser search for amortization calculator. And I'm not promoting this particular website, but this is one of the websites that's pretty nice. And you could put in the loan and the terms of the loan, and it'll construct an amortization table. I like to use this as a double check rather than my actual tool, because if I do it in Excel, I can put it in with my other worksheets, and I can also make adjustments to break out like the yearly basis or make pivot tables from it if I need to break out how much interest I had in a particular period or something like that. So that's what we're going to do over here. I'll just construct an amortization table. All right, so let's see how that works. This will also give us an idea of what we have to do from the bookkeeping side and why it's a problem, so that we can address that in however way we think is best, depending on what we're doing. All right, so I'm going to select some space. I want to put the financial statements on the right. So I'm going to put my cursor on. Wait. This is the actual amortization schedule we'll make right here. Here it is. It's right here. This is what we're going to do. So I'm going to do that. So let's do that. We're going to go over to the month 2, and then I'm going to scroll all the way to the right, and we'll see that we have our financial statements over here. Now I want to move the financial statements to the right because I always want my financial statements to be the furthest thing to the right in my worksheet. So I need to add some cells to the left of it. So I'm going to put my cursor on DM. I'm going to go all the way to like DV possibly, and then right click and insert. So that makes a bunch of skinny cells. I'll make them a little bit wider here. Let's make them a decent size. Okay. All right. And so that looks good. So now let's build our amortization table. So I'm just going to say, let's put the information here. I'm going to say the loan was $72,000. Now I know that we put that loan on the books with a couple different transactions, but for our purposes, we're going to pretend that we've refinanced the loan. The loan is starting now. It's at $72,000, and we need to build an amortization schedule. So what do we know? We know that the years of the loan are 5 years. We're going to imagine. If they say the loan is for 5 years, how many months is that? They might give you the length of the loan in months or years. So if they give it to 5 years, well, 5 times 12 is the number of months. And then we need the rate. So the interest rate, meaning the interest is in essence the rent on the purchasing power of the money that we're getting. So I think it's useful to think of a loan as similar to paying rent for an office building. If you pay for an office building, you're paying for the use of the office building as you use the office building. That's when the rent becomes due, or that's when you've incurred the expense, right? Same thing is happening here. They gave you $72,000. Why? Because we needed that money to invest in the things we need to generate revenue, property, plants, and equipment, and inventory, that is. And so in order to rent that purchasing power, we're going to have to pay interest, which is the rent on the purchasing power of the money that we got. So we're going to say it's 0.05, just 5% generically. Home tab, number group percent. Another thing to keep in mind here is that when we say, whenever someone says a percent and they don't specify a time period, the default is that we mean 5% a year, right? That's what it means. That's similar to saying if someone asks you, how much money do you make, or something, like if I ask some person how much money do they make, they're probably going to assume I mean a year. They're going to say like $60,000. They're not even going to say like $60,000 a year. They could just say, well, I make, $60,000. That means a year, right? Obviously we can tell by the number, but obviously that's kind of the default context. Same here. Now notice that you could give the interest rate per month because that's when we're actually going to pay the interest, but you will end up with a very small number. That's why we don't use that number as our normal parlance of talking. There's also a compounding kind of question that could manipulate how people represent the interest payments. You got to be careful with that information. The default, what we typically like to see is on a yearly basis, because that's going to give us a number that looks, it's between 1 and 100, right? Typically. So then the payment is going to be, we could use a payment calculation. Now, normally, if you were to get a loan, what they're going to what the number that they're focusing on is the payment number, because they're going to use that for budgeting purposes to see if you can pay back the payment number. But obviously what we're concerned with as well is how much they're charging us the rent on it. That's going to be an important component. Notice that what they're trying to do is make the payment number the same, even though the loan is being paid down over time and interest is being charged. That's kind of, so in order to do that, that is why the payment, the interest and loan principles differ. Because if you want to keep the payment the same, then that means that the loan and interest proportion of the payment is going to differ throughout the life of the loan drastically. So let's do a little formula to calculate the payment calculation here. It's going to be, I'm going to say negative PMT, payment, and then it's going to give us a little formula thing here. We need to calculate this. We need the rate, 5%, comma, and then the number of periods. Notice you might be tempted to put 5 years, but no, we're going to put 60 months. Okay, and now I have a problem here because I could have put 5 years with the 5%, but I actually want the periods to be 60 months. So that 5% actually is incorrect because it's the yearly rate. So how do I convert it to a monthly rate? I take that 5% divided by 12. So that'll give me my monthly rate, and then comma, and then the present value is the loan amount at this point in time. It's the $72,000. That gives us a payment of 1359. Now that's rounded, so if I add decimals, it's a little bit higher than that. But I'm just going to keep it rounded for now for our purposes, taking the pennies off, making it look a little bit more simple. All right, let's make that blue and bordered. I'm going to select Home tab up top, Font Group, drop down. Here's our blue, and then borderize it. Okay, let's make a skinny do column, D-O, the do column. I'm going to make it skinny. Home tab, Font Group, Format. We're gonna just do it, which I guess is exercise, which made it skinny. So we're gonna say this is the months and payment. These are my headers. Interest. This is gonna be the loan reduction. You could call it principal, but I always misspell it. Loan balance. Okay, so let's format this. I'm gonna select these. Home tab. Header formatting, dropping it down, making it black, making it white, and then I'm actually going to wrap it as well. I'm going to wrap and center it up top, and then I'll center it. So this one, we can make this one a little bit larger. So now I wrapped it, which I usually don't like to do because it makes this cell wide, but it's fine here because I've already done that. I've already done that over here. So we have this wide cell that we've been dealing with the whole time all the way through. So that's cool, the fact that otherwise I would put it on two separate lines, make it black and white so it still looks like a header. All right, so then we're gonna say, now notice I could add like one more column like for the years. Let's insert another column. I'm gonna put my cursor in here, right click and insert, and maybe I make this let's make this the months, and then we'll make this the years. I'll try to put a years number in there, but our major calculation is for months. So it's going to be 0, 1, and there's 60 of them. So I'm going to select those two. It should then be able to see the pattern and drag it down. Look, it gives me that little number on the side. So that means I can drag it down pretty nice and easily down to 60. So right there. And then on the years, the reason I'd like to have a years column is because I might want to add up the amount of interest per year. So what I'd like to do is reference and have a 1 for all of the years down to 12, because there's 12 months in a year. And then at 13, that'll be 2, and so on. So how can I do that with a formula? So one way I can do it is say, okay, I'm going to use my rounding function, and I'm going to say, I want to say equals round, and then I want to round it. I'm trying to remember how I did this. Round up. We want to round it up, and then I'm going to take the month number. In this case, it's 0, but we'll take the 0, and then I'm going to divide it by the months in a year, 12, and then comma. I want it to show me the digits. How many digits do I want? 0, which means it's going to go to the whole number. So what that's going to do is going to take all of these numbers, divide it by 12, and then round it up, which should give me a 1 for year 1, a 2 for year 2. So I'll show you what I mean here. I'll say enter, and then let's copy that down. Now if I go down to 13, it should do what I want. So now it goes to 2, right? So if I add some decimals, see how it's got no decimals because I rounded it to the whole number. So see what's happening here. Like for this one, I'm taking this number 1 divided by 12, which is going to have a positive fraction, and then I'm rounding it up to the whole number, which is what this 0 is doing, which will give me a 1. And then for this one, it's 2 because it's taking 13 divided by 12, which is going to be 1 and a fraction, which rounds it up to 2. So if I copy that down, it should go to 5. It should go out to 5 years. So now I can see the years in that column. That's nice. Okay, and then the loan balance I'm going to put on this side for year 0. So I'm going to start at the 72,000. All right, and then we're going to put the payments. Now the payments are going to be equal, and I'm going to just pick up this number, remembering this number is actually rounded, meaning the actual number here, like I didn't round, it's not 1359. Excel sees that as 1359 decimal 0.7. But I'm just gonna put it here without seeing the decimals, noting that the decimals are there. Whereas this over here, notice there are no decimals because I rounded it, trimming off the decimals completely. Over here, you can't see the decimals, but Excel still calculates based on the decimals. All right, so the interest calculation is going to be for 1 month, the balance, 72,000 divided by or times 5. Now, if I did 72,000 times 5, I would get 3,600, which would be the interest for an entire year. But we only have 1 month. So you could take that and just divide it by 12, and that'll give you the interest per month. The other way you might see that is you might say, well, I'm going to take the 5% divided by 12. That would give me the interest rate per, so right, if I percentify that, you could see it here, interest rate per month. It's very small. That's why we don't use that as the convention, but that's another way you can kind of view it. I'm undoing all this so you might see it as 5% divided by 12, giving me the monthly rate times the 72,000. Gives me the same number, 300. All right, so the loan reduction. So if I paid $1,359, but the interest is the rent that was paid, which I'm not going to get back, the loan balance, which I owe to the bank, is only going to go down by the difference of those numbers, which is 1059. And therefore, the loan balance was at 72,000. It's going down by the 1059. All right, let's do it one more time, and then I'll think about how we can format the cells so I can copy this down easily. So the payment is I'm just gonna say that equals the one above it. And then the interest, let's do that again, equals, now it's at 70,000, so it's lower. Therefore, the rent should be less because I'm borrowing less money at this time, times the 5%. That would be for a year divided by 12. So now the interest portion is only 296. The loan reduction portion therefore is going to go up because I'm still paying 1359, but the rent is only 296. So therefore the loan reduction, the principal, is going to be only a reduction of 1063. 70,941 minus 1063 is 69,878. Now let's think about how I can copy this down. If I say this is equal to the one above it, I can copy that down. The interest, notice I'm picking up this number, and then this number is outside of my table that I'm working in. It's in my data set. So if I copy that down, that's where the problem is going to be. If I copy this whole thing down, all the relative references move down except this number is wrong because it moved that down. How do I fix that? Control Z, undo. I'm going to put an absolute reference here in DN5. I'm going to say F4 on the keyboard, or you could just manually put a $sign before the letters DN and the number 6, the $sign having nothing to do with the money, having to do instead with just computer code. For whatever reason, they chose a $sign to tell Excel, do not move either the horizontal or vertical positions when I copy the cell down. Each of those $signs saying don't move the horizontal, don't move the vertical. All right. So the rest of them are good because I do want these to move down and I do want both of these to move down. So it's only the one that's outside my table, usually the one that's over here in my data set, that I need to make absolute. Then I can select all these. I could grab the fill handle, drag it down, or just double click on it. It's a fill handle button now. And then boom. Now if I go to the bottom of this thing, it should go to 0 at the end because that's going to give us my double check that it's fully been paid off. That's going to give me kind of a check figure. So now if I look at this, notice what happens to the payments and interest as we go. The payments are the same, but the interest part of it goes down and the principal part of it goes up. So that means the last payment I make is basically all principal, whereas the first payment I make is all is a lot more, at least, of interest. So that's gonna mess up my ability to bring it in for the recording, to automate it on the bank feeds, because these two numbers are gonna change every time. So we'll deal with that next time, but that's gonna be the issue. Now, the other thing to note here is that you might think, like, at the end of the year, we're gonna have to break out the short-term and long-term portion of the loan. Notice that the interest for a year, if I select these, I could see down here it calculates at the 3305. That's the interest, right? And so the long-term portion of the loan is the balance down here, the 59,000. So the current portion is this bit, and then that's the long. So we'll deal with that when we do the adjusting entries. Now, note that if I did a calculation over here, that it gives me I can put the 72,000 in, say it's a 5-year loan, no months, interest is 5%, tell it to calculate it. It gives me the payment, 1,358, which is I believe what we got here, right? It's rounded. And then it gives you the total interest over the life of the loan, and it gives you your amortization table. So I can kind of use this as a check figure, like I have 300 and 1058, 296 about, right? 300, 296, and I can see that looks like it's lining up properly. Now, the reason I like doing this in Excel is because I might use this table to do other calculations, and if I want to break it out on a yearly basis or something like that, then I could make this into a pivot table, for example. And now that I have the years over here, I can pull out each of the years, and I can see the payments for the year and the interest and so on for the year. So this is actually more dynamic for me. I'd prefer that, but obviously you might also use the tables. You can look up calculators on online website. I like to use the online website as a double check that what I've done in Excel lines up to the online calculator so that I can manipulate what I do in Excel. All right, let's select this entire thing and make it blue and bordered, blue and bordered. Okay, could we make this one a little smaller? We'll make it a little smaller. And then this one, we can make that a little smaller just to tidy this thing up a bit. All right. And then I'm going to delete this column. We don't need this column, it's useless. We might need it later, but I'll delete it for now. So we'll delete that. And then this DV, I would like to make it a skinny. I want to make it the same width as this do column. So let's do it. We're going to go to the Home tab, Format Paint to the DV column. So that looks good. Okay, so now when we make the payment, we'll show the first couple payments next time. And so here's the problem. When I make a payment, checking account's going to be hit by the 1,059 going down by that. But for the first payment, interest expense, the rent on that money, is $300. That means the principal is going to go down by 1,059. So what's the journal entry? Checking account goes down by 1,359. Interest expense, the equity side, is hit by the 300, and then the liability goes down by the 1,059, resulting in the loan balance on the liability should be remaining at 70,941. Whereas payment number 2 still has the checking account hit by 1,359, but The interest portion, the equity side, is only going to be hit by 296, which means that the loan reduction for the second payment is now 1,063, decrease in the liability, bringing once again the remaining loan balance to 69,878. So notice why it's useful to have our accounts, each one account per loan, instead of breaking out short-term and long-term each payment, and having a different account per loan so that I can tie this ending balance here into what is on my financial statements, giving me a double check that everything is working. Now note, this is tedious to do. We'll do it this way in the future, but if you want to automate the process, you would say, okay, I'm going to make all of these payments, just reduce the loan balance, which will be incorrect because you will not be recording the interest. But at the end of the year, or possibly at the end of, but most likely at the end of the year, you can then take your amortization table and record a journal entry for interest expense for the year, and then loan payable, which should adjust your loan balance properly to that point in time. That way, again, you can maybe save time. You can automate your loan payments, do it on a cashed basis, and then just fix it with an adjusting entry. That's kind of like one of the points of an adjusting entry, periodically, either yourself or make sure that you're communicating properly with your tax preparer to make that adjustment periodically at the end of the year when you need to do either taxes and or financial statement reporting.